It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm Annabelle Droulers with David Ingles.
We are counting down to the open up markets in Greater China. Let's get to your top stories today. Stocks across the Asia Pacific dropping as oil and gas prices are surging, with Iran and Israel trading strikes on key Middle East energy facilities. Now, Tehran says sites across the Gulf are now legitimate targets.
The Fed holds rates and raises its inflation outlook. Chair Jay Powell citing uncertainty over the impact of the war in Iran. Bonds as well set for their worst month since 2024.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Tencent shares are likely to drop in the session today. That's after ADRs fell the most in 5 months, with the company scaling back buybacks to spend more on AI. Welcome all to the program. We have lots to get into today. Everything from the latest in the Middle East, what's happening in the energy markets, how the Fed is looking at what's going on there, and what that means for the rates outlook, and of course, just the earnings story here in the Asia Pacific, particularly in China. Let me get started, of course, with Iran. And it seems like the news flow overnight, and looking at how oil is trading right now, seems to have taken a turn for the worst in terms of just the energy infrastructure that's now perhaps in play there.
Yeah, I mean, there's been some really fascinating comments coming out of this. Not only do you have Asia being disproportionately affected, but also some of the people we've been speaking with are saying that it's now hard to see the Qataris coming back to the market before the middle of the year, and even that is maybe ambitious. So is it a problem that we haven't fully estimated for or accounted for just yet, particularly, as you said, very much a live situation? Right.
The question going into, I think, at least going into the last few days was, theoretically, if the war ended, say, over the next 24 hours from that point in time, how quickly does energy supply come back in, and how quickly does energy that's simply just stuck make its way to the global market? And I think you have no doubts over that possibility coming to fruition. And I think when you look at what the Fed did and how they set it overnight, they have still priced in a cut for the year. Bond markets, look at how yields have moved since that point in time, are clearly not believing they'll be able to do that. In fact, right now, going into the Asia Pacific, we'll show you it later on, that a cut is no longer base case as far as rates markets go.
Yeah, and again, just so much uncertainty. But just listen to what Jay Powell had to say.
The thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through.
So there was a clear market reaction off that. You saw yields moving higher at the front end. Yep. You saw stocks moving lower. I think what's also interesting is, of course, the earnings that we're continuing to get through. And Tencent was one of the really notable ones after the session yesterday. And I thought the numbers, there was actually a lot to like in the numbers, but investors still were really focusing in on the negatives here. And of course, it's that bigger AI spend that we're going to get. How much does that impact their profit margins? And that seems to be maybe the reason you saw a bit of a pullback in ADRs.
Yeah, I think that, you're right. The narrative was because they're taking some of the money that actually helped prop the stock up and keep the stock up.
Share buybacks.
The buybacks, they're taking it from that. But the dynamic of being punished for CapEx spend seems to be working in against the Tencent story. And, a lot of the guests that we've talked to, and one of the ones we're coming on as well, is that the market is focused on the wrong thing when you look at the fact in Tencent. Anyway, we'll look at Tencent in a moment because there's that's really going to add to the risk worries, to the worries across the markets today, on top of the strong dollar. The Philippine peso that's coming up, if not already, has weakened through that 60 per dollar level, which the central bank, and very clearly, in fact, when you talk to authorities there, have really moved to defend and really become active. And yeah, as things open in Manila, dollar peso, as you can see, right through that 60 handle. And I wonder right now whether they're going to come in and soothe these market moves, given all the volatility that's taking place here, Bill.
No, I was just going to say on the currency front as well, we actually just saw the Korean won moving past that 1,500 level as well. So there's very clear FX implications from this of what's happening in the Middle East.
Yeah, absolutely. Energy importers, EM energy importers are really going to get hit today. So, in fact, you use a weak currency like the peso to buy oil in dollars, and when you look at oil today, this is the visual iteration of effectively how it feels to pull your nose hair. There you go. That's the pain you're feeling across these markets. We're up 3 to 6% on energy prices today. Yes, we are back above 110 on Brent. The dollar's coming through, dollar yen. So we talked about round numbers, a lot of central bank decisions today. The BOJ is next on deck. Then we have Taiwan, and then we move to Europe, where the ECB and the Bank of England. When you look at now coin toss odds for the Fed to cut interest rates this year, 160, speaking of round numbers, is one to watch on dollar yen. Europe, let's have a look at that and how we're trading across that market there. So that is really the pain point across. We're down 1.7% on futures there. Let's have a look at how we're trading across the region. Nikkei, Kospi, Taiwan, and U.S. futures coming on your screens. We're down 3% in Japan. Overnight, also a terrible session when you look at the Golden Dragon Index, how the ETFs traded in the U.S. Tencent obviously going to be very much in focus. That's how the ADRs traded overnight, mind you. We're likely to see some further pressure in the cash markets today, and in fact, futures coming up on your screens. Yes, there we go. We are down 1% on A50 futures in the opening minutes on the back of everything that's taken place in the Middle East.
Yeah, let's get more on that now, because as you said, really one of the top lines for today is that Qatar has reported extensive damage to the Ras Laffan industrial city. It houses the world's largest LNG export plant. For more on this, let's bring in Bloomberg reporter Dan Murtaugh, who joins us this morning from Beijing. So, Dan, let's just get to the significance of this and how you're reading the market moves off the back.
Yeah, it's really hard to understate or overstate, the significance of it. The Qatar accounts for 20% of global LNG exports. Now, we don't know yet what part of the Ras Laffan industrial complex was damaged. In addition to the LNG plant, there's also an oil refinery, there's storage tanks, there's a couple other facilities on there. So the market's going to be waiting with bated breath for more news on extensive details on what's damaged, how long it's going to take to repair, and when are they going to get production going up again. And that last part is the really important part, because you look at the global gas market, we were expecting this year it to fall into this huge oversupply with new plants coming online in Qatar, but also in the U.S., other places. That would have brought lower gas prices, lower energy prices to emerging markets like Thailand, like Pakistan. Now this is completely reversing that. In the near term, the plant was shut down because of the attacks in Iran already, but now we're looking at potentially months, if not longer, of a shutdown, which would completely flip that oversupply into an undersupply for this year. That would have long-term effects on emerging markets all across Asia.
Yeah, Dan, can you talk more about that? The exposure of Asian economies in as far as what the inventories are currently, how many months are we talking about, and who's the most exposed in the region in the event that takes longer to heal?
Yeah, Qatar sends most of its exports to Asia. The biggest are the countries you expect, like China. But China's actually not very exposed because it has big domestic production, gets pipeline gas from Russia. If you look in terms of percentage, we're talking about markets like Taiwan, India, Pakistan. Those guys, a fifth, a quarter of their total gas consumption comes from that Qatari plant. And so they're looking at major hits and having to spend a lot of money to replenish those. Or, the other option is you don't replenish them and you tell your factories, sorry, we're going to have to curtail your gas use. That can have ripple effects all across their economies.
What about also what we heard from the Islamic Revolutionary Guard Corps as well about other energy sites that could be targeted, not just in Qatar, but Saudi Arabia, the UAE? Is the market also reacting to that, or do you think it's predominantly this plant now being taken offline for a lot longer than perhaps maybe had been anticipated?
We're certainly seeing, the oil market is giving a little bit of a response to these widespread attacks, and just the idea that the whole situation there is clearly not anywhere closer to resolution than it was when we went to sleep the night before. But it's not just this Qatar plant. It's obviously the single most important. But there's a huge gas processing facility in Abu Dhabi that's shut after it got hit by debris from an intercepted missile. Saudi Arabia, announced some incoming missiles that it had intercepted. So the attacks on energy infrastructure are spreading, and that all started earlier yesterday when Israel hit Iran's biggest gas field, the South Pars field, which supplies most of its country and also exports to Turkey and Iraq. So up until now, most of the threat has been just on the Strait of Hormuz blocking off any kind of energy coming in. But now there's this new threat of actual energy facilities getting hit and shutting down for weeks, months, maybe longer.
Dan, thank you. Dan Murtaugh there with the latest on what's moving markets today with the spike in energy prices. The other thing we're tracking this hour is the likely pressure we'll see on shares of Tencent, hence also futures are down about 1%. The company's planning to at least double its investments in AI this year to more than $5.2 billion, underscoring this big bet on open-clause-style agents. Min Lo has been poring over the details of the results, and markets don't seem to be liking at least one part of those results.
Yeah, I think to Belle's point, actually, we got a very solid set of results. It's the fifth consecutive quarter of double-digit gains in revenue, particularly boosted by its cash cow, which is the gaming segment, which surpassed expectations, particularly its international gaming segment. But again, there's been a lot of focus on AI, right, particularly with this open claw moment and this, the frenzy around that. And the company is saying they are doubling their investment in AI. Last year, it spent 18 billion yuan in its large language model and its chat GPT-like app called Yuan Bao. So this means that this year it might spend at least 36 billion yuan, but that's still very little compared to what Alibaba has announced. At the same time, of course, how is it going to monetize that is the question, because that's going to drag on profit as well. And the company has said that it's going to reduce share buybacks as a way to raise those funds for the investments. That could be why many analysts are cutting back their price targets. At the same time, I think there was a lack of clarity at the earnings call yesterday in terms of what sort of investment target, what sort of products are they investing into, what sort of targets when it comes to talent acquisition. What is the timeline for the rollout of their own agentic AI service on WeChat? So it's just not enough to whet investors' appetite.
Yeah, I still find it interesting, though, because out of any of the big tech in China, you could say that Tencent is probably one of the best positioned to create agentic agents. But anyway, Alibaba, as you said, I mean, they've had a much bigger capex spend on AI in the past. What do you think we're going to get out of these results later today?
So Alibaba, they have two big business segments, right? One is the e-commerce and the other is cloud. So e-commerce, we are expecting a bit of a drag on its profits because of the expansion into quick commerce, the battle with Meituan. It's been spending a lot on promotions. It's going to be better than the first half of the year. There's a bit of stabilization in market share there, but still not going to be great for the profits. But when you talk about cloud, it's always been very strong growth for Alibaba. So we want to see if that momentum continues, particularly when there has been strong demand for AI computing power. And of course, again, whether they will revise upwards their AI capex spending as well. And for Alibaba, it's been a leader when it comes to large language model, but it hasn't yet translated that into a commercial lead. So again, how are they going to monetize that is a big question.
Min, thank you. Min Lo, our China correspondent there. We're counting down to the open at market, 16 minutes away. So we're looking at Alibaba set to report. Tencent has reported. We're looking at shares likely to drop at about the open today. And of course, we're looking at all the breaking news coming through, including some of the weakness in the EMFX space. Like the Philippine peso is now trading above the key 60 per dollar level. Lots to get into. The opening bell 15 minutes away. This is The China Show. A50 futures are down. Okay, we're now session lows on that one, 1.2% to the downside. The fix is just out. Most of the heavyweights are indicated lower. AIA, Tencent, just mind you, right? The only drop beyond 5% we've had in the last 12 months was during Liberation Day. We're likely to test that superlative today. We're at 550 yesterday. We're looking at 522 going into the session today. So it's not going to be a good one if you're long these assets. Right. A lot of that also has to do with the fact that the Fed might not be able to cut interest rates this year. In fact, we've now gone to, it's not just coin toss, right? 45% probability based on Fed fund futures the last few minutes or so of a cut before the end of this year. Right side of your screens is the monthly performance of the Bloomberg Aggregate Index, which tracks, of course, fixed income. And currently, as things stand, we are set for the worst month since in about 17 or 18 months. So it's, not encouraging.
Yeah, well, let's get more on this. Bring in Gordon Tsui. He's Managing Director and Head of Fixed Income at Ping An of China Asset Management, Hong Kong. So, Gordon, I mean, yeah, Dave just laid it out there for us. Obviously, it's a very much a live situation trying to recalibrate where the Fed goes, just given the uncertainty around energy, the uncertainty around what that means for inflation. But how are you thinking about the situation and the outlook as well?
Thank you, Annabelle. In fact, the Fed is doing its job of dealing with this uncertainty because of the Iranian war. When the inflation is going up, I think they maintain, stay put, and then we keep the market that they will do their job to keep inflation in check. I think they are doing a very good job.
The Treasury market, U.S. Treasuries have obviously acted as expected, given break-evens moving up. Is this a buying opportunity?
No, I expect the 30-year bond yield will go up about 5%, and I will not buy because right now the U.S. is in the center of this Iranian conflict, and the military spending, it can go up in the order of trillions if you look at the Iraqi conflict from 2003 for 10 years. Who knows how long it will last?
So then where are the havens then in this sort of environment? What are you actually looking to?
From a high level, right now, the local currency for the major economies that did not participate in the first round of this attack, like Japan, like UK, they will be attractive to the local investors. They have large savings pool to buy their own government bonds.
I wonder if, so we know U.S. President Trump, and I think by experience looking at what happened in April of last year, he listens to the bond markets more than he does to the equity markets. Has the bond market sold off enough to get him to listen, to back off what's going on in Iran, whether that's pricing in inflation or pricing in a prolonged conflict and them needing to expand spending? How do you look at that? Because that then affects everything else beyond where you are in the Treasury curve.
That's right. In fact, from a rational expectations theory, in fact, the bond market is pricing in this military spending as well as the tariff. Now it is gone. Nobody talks about it. And the ongoing cost from those returns, it will be adding up. So right now, in fact, the government, maybe the Trump administration, they need something signal. Even their anti-terrorism head, Joe Kent, could not convince Trump to back off. So we, the bond investors, may be having to take this road.
How does the fact that obviously Jay Powell's term is ending soon, Kevin Warsh, it's still, he's not confirmed just yet. They don't have enough votes either for that. How does that also complicate the trajectory, do you think?
I welcome, Jerome Powell taking this role as chairman pro tem because it at least remove one uncertainty. We have to predict what is the reaction function of Kevin Warsh. If you look at the past change of guard at the Fed, Ben Bernanke, global financial crisis ensued, and then Janet Yellen, the 2015, even the stock market has some volatility. And Jerome Powell's own term, when he started, it was the Christmas Day, massacre in 2018. So for us, I think his term extends to maybe later this year. It actually removes one uncertainty.
Oh, okay. That's something not a lot of people would be expecting. Maybe just to follow on this track of good news we're talking about here, private credit's been acting up quite a bit, and spreads have been, I wouldn't say blowing up in the public markets. We've seen them widen Can I make a connection between what's happening in the IG space and worries in private credit specifically? And how do you think that's going to affect the public fixed income?
In fact, we have a bond portfolio about $1 billion in the U.S. investment grade corporate. So all these hyperscalers bonds are inside this index. We have to.
Are you sure they're all investment grade? I need to cover my bases.
Many of them still have a positive cash flow.
Okay.
But from my existing strategy, we have to keep zero rating because right now when they are coming to the market, the spreads will be widening due to this new issuance pipeline. We will participate in the new issue, catch up, be a few pips, $1 for this long dated, but we need to be tactical and buy immediately, sell it.
How are you thinking about issuance then of dim sum bonds? Chinese companies issuing offshore?
In fact, like Tencent or maybe Alibaba, in the past, they relied on the US dollar credit market. But now, it is the national policy for them to help grow the dim sum bond market. They are doing this job. I think they will just issue maybe long-dated, even 30-year dim sum bond, and then help grow the cross-currency swap market, the CNH versus US dollar cross-currency swap market, and take this US dollar after using this swap market and do M&A of these offshore, overseas acquisitions, just like in the past.
And what opportunities do you think, specific opportunities do you think foreign investors should be looking at in the CNH market amidst all the gyrations we're seeing outside?
If you look at the Bloomberg dim sum bond index, in CNH term, it is performing. But if you look at the US dollar translated return, it is even better, up 2%. So the renminbi bond is helping investors to diversify away from the US dollar market. And I think down the road, in 3 years' time, it can grow to 10 trillion from the current 1.6 trillion.
That's a very significant increase. What would be the sort of catalyst for that, and why do you have such a significant target?
Right now, the onshore bond market is 160 trillion, while the Hong Kong, offshore market, including other centers, only 1.6 trillion, only 1%. If the government, for example, mandate these onshore large asset owners to allocate like 10% of their onshore bond exposure to this dim sum bond market, is already surpassing this 3-year goal. And I think Hong Kong domiciled asset managers can help these onshore Chinese investors to grow this market.
Final question. We started off with Iran and energy and inflation. I want to end on that if it's okay. So we're halfway through March. It's been challenging, obviously, for fixed income. Do you think we should be prepared for inflation globally?
In fact, every day the gas price at the pump is up 5 cents per day, US dollar. And right now, I think compared to the State of the Union that Donald Trump Brent is up already more than $1 or so. So people should expect shortage as well as maybe food crisis if this war is prolonged, because all this urea, the fertilizers, they are missing the spring, sowing season. There is no use to just use these fertilizers in the summer months for India, for the major, agricultural countries. It is a disaster, and also not to talk about the environmental, pollution problem.
Okay, well, nothing personal. I feel more depressed after speaking with you, Gordon. Thank you so much. It's a good thing you're wearing a very nice colored suit
Thank
today.
you very much.
There we go, just to add to a little bit maybe juxtapose. Gordon Tsui there, of course, Managing Director, Head of Fixed Income at Ping An of China Asset Management in Hong Kong. Really real on the situation where this is probably headed, looking at prices right now. Right, Tencent shares, we've been tracking this. We are down 4% in the early goings. AIA did announce a buyback. Shares are also down, and Weibo, tracking what we had on Wall Street overnight, also down about 10%. Oil and gas in China very much in focus too.
Yeah, that's right, of course, because we're seeing a big spike in energy names, essentially, or energy prices, and no surprise then you've got those companies that are moving higher off the back. Just quick check on HSBC as well, given we had a really interesting Bloomberg scoop coming out in the last hour or so, but essentially looking at perhaps some really significant job cuts due to AI and the productivity gains they can make from that. But we'll get more with the pre-market ahead. This is Bloomberg.
Right, welcome back. You're watching the China Show. We're counting down that much amount of time to the Thursday Open. If you're long these markets, couple of things. Maybe just close your eyes. If you're set to look at your gas power bills, maybe to borrow a phrase from the late Bob Marley, turn your lights down low, looking at how this is going to affect us all downstream, given what's taking place there in the Middle East. We're set to open lower by 2% here in Hong Kong.
Yeah, it seems like maybe it's really starting to show up now, the seriousness of what's happening in the Middle East, because we had investors that were sort of shrugging it off after President Trump's comments that the war would end quickly. But now, of course, it's that assessment that seems to be taking hold. Yep. Maybe it won't. And you're seeing that really much reflected in trading activity, and also, of course, what happened with the Fed overnight, because they had to change their expectations around easing and only one cut being priced in. If you take a look what's being indicated in options or swaps, I mean, it's way back down to around a 45% odd of that even happening at all. So yes, investors are rethinking the situation essentially of what's happening in the Middle East and the implications. Asia, of course, is particularly affected by this, even though, of course, China a little bit more insulated just given its huge amount of reserves. And we are seeing Chinese ships that had at least been managing to pass through the Strait of Hormuz. But we are seeing stocks that are coming online in the red this morning. So you've got the broader gauge here off 1% so far in the session. Big spike, though, there you have for Shanghai crude up 7.8%. Again, it speaks to that energy story, given you've had Qatar, for instance, reporting extensive damage at what is the world's largest LNG plant, and we have as well seen oil and gas prices surging off the back. But otherwise, we do have stocks that are very much in the red today being led. You can see there the likes of Cambricon, for instance, down 2%. But let's take a look at Hong Kong, because we have this market coming online this morning, and we are, again, really seeing the very much broad-based selling, essentially. There aren't too many stories to like here today. Tencent's actually a really interesting one. We'll get more on this in just a moment, but we did actually have it reporting earnings, and as we've been discussing, really a lot to like out of those numbers in terms of the actual headline numbers, beats essentially, but investors are a little bit concerned about the spending on AI rather, and we are seeing that stock just dropping there. Xiaomi, you can see it's actually gaining 2.6%, more models being released, so that is actually helping their shares this morning. Quick check on the oil and gas stocks. As we said, we have actually seen those gaining in pre-market, and that is holding into the session so far.
Yeah, and you can see why, right? 3.5% on Brent crude, bottom of your screen. Let's take it back to Tencent. So we're now set 5% drop, should be the biggest drop in 11 months. You got to wonder whether or not this is simply just a short-term reaction in markets, given that buybacks were a fairly decent feature in share price conversations, and whether or not because they're dipping into that specific jar to fund the AI trade is a bad thing or a good thing. I don't know. I don't know what to believe these days. Jiong Shao is with us out of New York, China tech analyst at Barclays. Markets, you say, are focused on the wrong thing. What is the right thing these days?
First off, thank you for having me on. I think the investment in this particular AI arena is a great thing. It's not just a good thing. But, you guys were just talking about Tencent numbers, right? The results were very strong. It beat across the board. Revenue growth of 13-14% with profit growth of high teens. So there was nothing wrong with the numbers. But that's not where the most interesting thing is. The most interesting thing is that there's only one word, that is open claw. Now, for some of your viewers may still remember, 15 years ago, Tencent came out with WeChat. And WeChat is driving a bulk of Tencent business today. And we think this open claw phenomena, in Tencent's case, it's called Q-Claw with a few other products, is equivalent to that WeChat moment 15 years ago, right? Jensen Huang from NVIDIA said, I think yesterday or the day before, at their global GTC, saying that OpenClaw is equivalent to HTML. I mean, without HTML, there's no website. And he also said OpenClaw is equivalent to the ChatGPT moment. So we think for Tencent to go all in OpenClaw is not just a good thing, it's a great thing.
And when you look across the China tech landscape, because obviously they're not the only ones that are pursuing some sort of agentic AI, but just talk to us about the positioning of Tencent in this landscape and why it's actually probably better or the best positioned as well.
Great question. So before the open claw, Tencent was often viewed as a latecomer, right? The management said themselves on the public call that they were not early on in their large language model, and their model may not be considered the very best in China. But the overall problem is that before OpenClaw, the entire industry was having difficulty in figuring out how to monetize this large language model, because the model can solve some amazing math problems, can code software, has nothing to do with most people's lives. So OpenClaw almost acts as a web browser that came out 30 years ago. That's sort of the bridge to allow regular workers or just consumer users to use the power of AI for these large language models in their daily lives and in their productivity enhancement tasks. Now, this becomes a sort of a equalizer, because all of a sudden, Tencent has something they can put their arms around to create these sort of apps or the AI agents to leverage the power of not only their own large language model, but also other people's large language model as well. And as we all know, Tencent is absolutely the best in terms of the producing and marketing the consumer or facing apps or user facing apps in China for sure. Again, some of your viewers may still remember, they were not the first one who came out with this chat app like WeChat, right? They were not the first, but they become now WeChat is ubiquitous in China today.
Can you just spell it out for us, though, the actual monetization side? Because we know that consumers in China have a low propensity to pay, but where is the ROI here? Is it that you're drawing more users into the Tencent ecosystem? Where exactly are they generating revenue?
So the bulk of the in the whole open claw phenomena is going to be the revenue and the TAM is going to be in the enterprise space. China has never had a software industry. As a result, never had a SaaS industry, that's software as a service. But now, with this AI agents, particularly these AI agents developed upon this open claw platform, China may leapfrog the whole sort of software and the SaaS industry to have this sort of upgraded version of SaaS for the Chinese businesses, and large and small. Now, even for the consumers, it's hard to ask them to pay $20 or 20 RMB if you just give them some sort of a upgraded version of search like most chatbots are. But if you provide them some AI agents, become a digital agents for them, for their daily lives, make their life a lot easier to do things, not just to give them the answers for things, I think the willingness to pay is significantly higher. And as you probably know, a bunch of these Chinese internet companies already come out with pricing mechanism for their own cloud, no matter it's Alibaba's JVC cloud, or it's Tencent Q cloud, or Minimax Max cloud. There's a monthly subscription fee now for their cloud products.
So clearly you're bullish on the stock, sir. Tencent's current market cap is about $600 billion, that's US dollars. Alphabet, just as a broad comparison, is 3.7, so multiples larger than Tencent. How much do you think Tencent should be worth?
So for the Chinese stocks in general, or for the emerging market in general, the multiples are a lot lower. That's just fact of life, at least in today's market. And I think our target price for Tencent, based on some of our valuation analysis, to use some of the parts to come up with a number and our target price is about 100 US, which is about 780 Hong Kong. I think there's a lot upside from current stock price. Another thing to add to what I said earlier about the monetization, because of these claw agents consume so many more tokens from these models, so all of a sudden the token demand has skyrocketed. You already start to see companies like Tencent, Alibaba, and Baidu are raising their prices because they simply cannot make enough token to satisfy the demand from these claw agents. That's another key way to monetize, at least in the very near term, because the demand is already there. It's today. You can make money today.
Yeah, I want to ask about that actually, Jiong, because yesterday, for instance, you mentioned Alibaba. We saw that price hike on its cloud side or a cloud product of more than 30%. How much should we read into that, given, again, coming back to that propensity to pay, and these have essentially been loss-making units or areas of the business?
So the fact they are able to raise prices, as you just mentioned earlier, Chinese consumers and Chinese enterprises, they don't like to pay for a lot of services. And enterprise, the reason China has a kind of software industry or SaaS is because these enterprises have been unwilling to pay for the software. But the fact now they're willing to pay, and there are so many tokens generated because of those services, and that's allowed them to raise prices. And it is a rare incidence when Chinese companies all of a sudden raise prices. That's a validation of the entire industry going forward.
Particularly given Bill's point earlier, Jiong Shao, that price sensitivity among Chinese consumers. Can I just ask, maybe come full circle here? It's been a while since we spoke, and I think the emergence recently of some new names in the AI space, Minimax, Zhipu, people are trying to figure out which horse to bet on. It's frankly confusing to many people what types of companies do what and what is the best AI. So how are you looking at this new cohort of AI plays in China? Where do you think things sit along that spectrum then?
Right. It's a very, very interesting topic. I think things are changing. Up until quite a month ago, a lot of these AI labs around the world, big or small, they're still competing against each other on, oh, my models are better than yours, and my model has so many more parameters and all that stuff. But at the same time, they were having difficult time to monetize. Now, because of this cloudbots, this surge in cloudbots adoption and surge in token demand, and you have heard some of the private companies such as Moonshot, they sold more tokens in 20 days than entire year 2025. So no wonder those stocks have skyrocketed as well. I believe Minimax has been up 5x since the IPO. Now, going forward, it becomes a little bit risky situation because, back to what I said about the open cloud architecture, because for the cloud bot, the underlying models can be easily switched in and out. So today, if one of the smaller AI labs has the best model, maybe my cloud bot uses this AI particular model and I pay them a lot of money. But if tomorrow, Tencent or Baba or anybody else, another unknown company, comes out and with a better model, I can easily switch to that. So then you say, okay, what's the residual value for your model? How likely you can always be the best? It's not likely in tech world. Things change all the time. So what's become more valuable is that, okay, who controls the user? Who has that relationship with end users? This back to the Tencent discussion is that Tencent or anybody else, ByteDance perhaps, is that if they have the strongest connectivity with the users, then the lining model doesn't matter which model. They can switch them out anytime they want to, right? So the value will reside in whoever controls that connectivity, not in the models itself.
Yeah, fascinating. You really need that ecosystem. Jiong Shao, it's really great to have you this evening. Thanks for staying up for us. That was the China tech analyst at Barclays in New York there. And just a quick look at Asian markets as we head into the break this morning. Of course, 15 minutes into trading for mainland equities, and we are seeing moves to the downside. More ahead. This is Bloomberg.
HSBC down 2.5% in the first 16 minutes of the cash market here. The bank is said to be weighing a wave of deep job cuts over the coming years as the CEO, Georges Elhedery, is betting on AI to shrink its middle and back office footprint.
Yeah, let's get more on this now. Bring in our finance editor, Adam Hayes. So, Adam, really great scoop from the team this morning. Laid out for us exactly. I mean, we've just sort of highlighted there the number of job cuts and the reasons why, but just give us more context on exactly how this has come about.
Yeah, well, I think really the big point here is just how kind of early stage this is in planning terms, but, potentially could be impacting, 20,000 people of their global workforce of 210,000. So clearly a very significant number of people. And really this is around kind of using these new technologies to kind of revamp the way that structurally they think about middle and back office roles within the bank. And of course, Elhedery, since he joined in 2024, has been, revamping the bank in many ways, and investors to a large degree have been rewarding him for doing that. You've seen a real rip higher in the stock price. So in many ways, this is kind of an extension of his overhaul plan. And although we understand that it's not something that's coming imminently, and it indeed is still in the planning stage, it speaks to the long-term restructuring of how he's thinking about this bank still being essentially too large from a cost perspective. And this is one element of how they can continue to address those costs and give investors more bang for their buck.
Yeah, I was about to say that's right. I mean, people have been talking about this specific stock as if it was the new Nvidia, and really, when you look at how it's ripped, it in some ways it is. Have we heard from the bank, Adam, in terms of have they responded to what they're said to have been mulling?
No, they're declining to comment at this stage, which you would expect from a story that potentially could impact staff of this kind of magnitude, and especially because it's still in the consideration stage. So I don't think we'll be hearing anything officially from them in response for the time being. But I think really, it's one of the real latest examples of just how the finance industry is readjusting to AI becoming kind of ingrained in a lot of the daily workflows, but also how much and how kind of deep it goes in terms of restructuring large parts of organizations where manpower can either be moved or shifted to other areas and replaced by some of the real advances in technology that we're seeing.
Yeah, I found it interesting in the story as well that you cited this statistic from a survey that we'd done, or Bloomberg Intelligence had done with CIOs and also CTOs, and generally the average is for headcount reductions of around 3%. So does that just tell us that banking is more exposed, I guess, to productivity gains from AI?
Well, I think as we're seeing, this is a space that's developing very quickly. So forecasts that were made 6 to 12 months ago are already feeling, somewhat out of date. And I think even just kind of outside the finance sector, what you've seen recently with some of the cuts that are happening in the tech space, that the kind of some of the Australian companies, Block and WiseTech, and those kind of firms, a lot of this is ramping up at a slightly faster pace than many people had appreciated, even coming into 2026. I would suggest. So some of these estimates are quite quickly out of date, just because of the fact that the technology is moving so quickly and companies are moving so quickly to be able to implement it and really revamp their businesses. So I think what's happening here also speaks to that the speed of change here is really quite surprising to a lot of people.
Adam, thanks very much for joining us. And as we said, really great scoop from the team this morning. That's our finance editor, Adam Hay, joining us. And let's get back to some other world news that we're tracking this morning. India is sending additional warships to the Middle East to ensure the safe passage of its vessels, in anticipation that Iran may allow more of its fuel tankers to exit the Strait of Hormuz. Sources have told Bloomberg the Indian Navy is deploying over half a dozen warships as a precautionary measure. Their mission will be to escort vehicles until they reach safer waters in the northern Arabian Sea. FGE says China is close to tapping its commercial oil reserves as the war in Iran shows no signs of ending. The analyst says a drawdown in commercial and operational stockpiles of up to 1 million barrels a day may happen over the next 4 to 6 weeks. Beijing has built up an estimated 1.4 billion barrels of reserves that could be tapped if the Strait of Hormuz remains effectively shut.
Yeah, we know you have a lot of questions out there, so in a couple of minutes we are doing this live Q&A on what President Trump's Hormuz pressure means really for the region, energy security, short and longer term prices perhaps. So if you're one of our digital subscribers or terminal subscribers, you can be able, of course, to ask our team some questions then. That's happening at the top of the next hour. It's also worth pointing out that we also are continuing the conversation here on Bloomberg TV on the specific topic of gas. That's coming up next. This is The China Show. Right, just for some other news we're tracking across these markets, you're looking at casino stocks, Morgan Stanley downgrading some of these names here on the back of effectively lower growth as far as the outlook is concerned here. On top of this, it's really take your pick, really from this a pessimist's guide to markets today, whether that's higher rates, higher energy prices, earnings that were actually good when you look at the Tencent beat. But the focus was really on the AI spend. That might be just positioning too. Who knows? So we're down 2% on MSCI China. Hang Seng Tech is down 1.5%. And we are continuing to see the steeping in the curve, quite literally, right? The 1 year is down, 10-year is up to the upside. 30-year is up as well here to 2.4%. Lots of central bank decisions to tell you about as well today. The Bank of Japan, possibly in the next 60 minutes, possibly. On top of that, you have Taiwan, you have the ECB, and the Bank of England. So lots to get into in the next hour of The China Show.
Welcome back to The China Show this morning. Taking a look at the Hang Seng half an hour into the session. Look, it is a beautiful day in Hong Kong, you have to say, but there is a significant amount of pain that we're seeing across the board. Really, of course, it's this rethinking around not just the energy prices, the inflation outlook. You have the Fed decision. There's lots for investors to be clinging to this morning, Dave.
Yeah, and the fact that you are hearing from central banks and they themselves do not know how this is going to play out, right? It's a timing duration thing, and I think Fed Chair Jay Powell overnight said it's really uncertain how this will eventually affect the consumer, right? And whether or not, in bond investors who are clearly looking at inflation and not so much demand at this point can't see through that veneer of inflation and see slowdown at the end, right? And I think when you look at what's happening with the energy markets right now, it's understandable why you're getting rate cuts being pushed back, if not fully priced out. You are getting tightening being pulled in. You have the ECB, you have the Bank of England, you had the RBA early this week, and of course the Fed, when you look at pricing right now, it's below coin toss odds right now of even a single rate cut from this point in time through the end of this year. But it is a moving target, and certainly the question right now, as you flip the page and look at the equity market iteration of this energy price move, is really to what extent, theoretically, if the war ended tomorrow, to what extent then we get oil, energy, gas specifically supply into the Asia-Pacific quickly up and running, or is this some sort of permanence to the damage across energy infrastructure in the Middle East? So this is how Asia looks on a sector basis. So we're down about, let's call it 1.7% on price. Volumes are on the lower side of things. And the pain points are basically everything else. Communication services, that's a Tencent story. There's obviously the financial story with HSBC. And yeah, guess what? Green, that's your energy complex right now. So the only big winner so far in the equity markets, understandably so given this massive spike. Again, we're seeing in energy prices today, Belle.
Yeah, and let's get more on that now because, as we said, the top story today very much is Qatar reporting extensive damage to the Ras Laffan industrial city, which does house the world's largest LNG export plant. Our BI team, or Bloomberg Intelligence, says the shutdown's going to take about 7 million tonnes of LNG out of the global markets each month. Let's get more now, or analysis now, with Leslie Palti-Guzman, founder and president of advisory firm Energy Vista. So, Leslie, thanks very much for joining us this evening. Talk to us about the impact and the significance of this, because as we're really seeing today reflected in markets, investors are very much rethinking, it seems, the broader impact and how long this also might last.
So what happened today with the fires and the strike on Ras Laffan is putting further away the normalization of Qatari LNG flows and the comeback of their cargoes into the global LNG market. So before those strikes, we could potentially see a restart within 2 months, maybe 15 million tons removed from the market. But depending on the scale of the damage, now, I'm planning for maybe 4 or 5 months of further delay. And that would mean, double the amount of LNG, so potentially up to 30 million tons of LNG being removed from the market.
So, Leslie, David here. So let's call it half a year. In the meantime, and clearly that's going to drive prices higher. In the meantime, what do you think is going on in as far as economies and trying to scramble for supplies? What are you hearing? What are you seeing?
Yeah, so we're going to see an acceleration of potential demand destruction. I'm looking especially at Southeast Asia and countries like Bangladesh, or South Asia, Bangladesh, Pakistan, India, that are very dependent on Qatari LNG, but they're also very price sensitive. So any increase in the spot LNG price will mean that they won't be able to compensate with spot LNG all the missing Qatari cargoes, and they will have to find alternatives with other fuels. It may mean more coal, or it may mean demand destruction and less use of power generation or gas for industrial use. For India specifically, it's problematic for cooking gas, for example. They are very dependent on LPG also for cooking gas. And that's going to be an issue even for fertilizer. I mean, it's a series of commodities that are impacted.
What about as well, I mean, as you said, we're taking a lot of supply offline, but we're also prolonging expansion products or projects rather that were underway. Just talk to us about that.
Yeah, so what's interesting is that there are 2 large global LNG suppliers right now. The 2 largest are the US and Qatar, and both are undergoing massive expansion of their capacity. And Qatar not only now has halted its existing volumes, so volumes of existing capacity, but it really also underlines increased uncertainty with the future volumes of its expansion. So as we see further damage, but also security vulnerability around Ras Laffan and its geography, not only because it's sharing this big, large field with Iran, but also because it has to use the Strait of Hormuz to evacuate those cargoes. There is increasingly, a big uncertainty hanging over this massive expansion.
And yeah, that's something that was, when I saw the headline, Leslie, yesterday, when things were kicking off, to some extent, I was looking at that relationship, Qatar and Iran. Obviously, the period of stability was, I guess, somewhat sufficient to keep the status quo. How should we be looking at that relationship after this?
I think it's crucial. The future of the Iran leadership, of what is going to emerge after the war, is going also to determine the future of the Qatari expansion and of the exports, because Iran and Qatar are sharing the world's largest gas field. And you need to have some joint agreement on how to produce this field, because gas migrates from one side to the other within the field. And if you produce more on one side, it impacts the other side. And there is this kind of tacit agreement between the two countries. We know also that Qatar had a self-imposed moratorium on its gas production until 2017, and it couldn't have lifted it without the approval from Iran. Now, if we come to another leadership that is more pro-American, that could be the best outcome for Qatar, because it would remove a huge uncertainty on how the future of this field, like what is going to govern the future of this field, and a more pragmatic government could realize that it's in its own interest to continue whatever existed before to govern the field. Now, if we have a government that is like whatever is remaining from the Revolutionary Guards, or a government that is adopting a more resource nationalism posture, or if we see a civil war or more fragmentation, that could put really at stake the agreement that governed the shared field.
Leslie, I just need to jump in here with some lines we're getting from President Trump. So he is talking about the attack that happened on Iran's South Pars gas facilities. We, of course, understand that's being contained, but it is an attack that is the first on Iran's upstream facilities since the war began, and as well an important field essentially for supply to the domestic market as well as to neighbouring Iraq and Turkey. President Trump is now responding to that, saying that it knew, or the US knew, nothing about this particular attack, and that there will be no more attacks as well, he's saying, by Israel on South Pars. So that's what he's calling for, and also threatening to attack, though, the South Pars field if Qatar LNG is hit. He is threatening to attack, rather to retaliate if Qatar's LNG is attacked again. I mean, how do you respond to this commentary from President Trump, and do you think that there is perhaps a need or a push, really, that we're going to see from the White House to essentially de-escalate the situation, or attempt to?
So what's interesting is that last summer, I believe there was already a strike on South Pars, maybe not much damage being done, and it was more a signal being sent. And I think, whether it's Karg Island or South Pars, the US and Israel have the operational military capabilities to strike those fields and resources. Striking those resources would put in danger the source of revenues for a more pro-American government in the future. So that's one of the main reasons why they want to avoid to target those energy infrastructure. However, it's still the Revolutionary Guards that are in charge of exports. And as a result, they are getting the revenues from those oil exports that are going mostly to China, for instance. So if there is a need for escalation and to remove those revenues to shorten the war, I don't think Israel or the US would hesitate. Now, I think those comments from President Trump means that the ball is in the camp of Iran. If you want to de-escalate and stop targeting also the Gulf countries, it's on your side. I would note that all the Gulf countries right now are telling President Trump not to finish completely the job, because they are going to be more at risk if there are still some Revolutionary Guards that retain some power and some military capabilities, because we've seen, and the world has seen, how their reputation has been damaged, and how in the future the trust that their customers for oil and gas are going to put into these countries will depend on how secure and reliable those supplies are going to be.
Leslie, just very quickly, if you can, what's the best case scenario now?
So the best case scenario is that we're entering a phase where the Iranian leadership from the Islamic Republic has been sufficiently degraded that most of the launchers have been removed. Same for the drones and their factories. So whatever is left is their inventories, and now they're lashing out and striking everything. But they have a depleted inventory and a depleted ability to strike. Their proxies also are increasingly degraded, from Hamas to Hezbollah in Lebanon. The Houthi have been quiet because they may understand that, they don't want to face the same fate as the other proxies. And also they understand that Iran cannot bring them more weapons and other resources. So I think Iran is very isolated right now, even if, China and Russia are maybe sharing some intelligence, they're not coming to the rescue. So the best scenario would be another 2, 3 weeks, 4 weeks of war, reopening of the Strait of Hormuz in the coming weeks. And from then, Israel, I think, has mentioned today that they would protect the population from the sky. And now their destiny is within their hands. And if they want to go into the street and start another, protest and march to bring to an end this regime that has obstructed all their liberty and freedom for 47 years, it's within their hands.
Leslie, thank you so much for staying up. Leslie Guzman there, founder of Energy Vista, joining us out of New York. Okay, there's a lot to unpack in this message coming through out of the U.S. president, chiming in on perhaps what to expect. If you simply just look at the entire message or post and look specifically at what is in all caps, which I think is the first thing that I would do, because there's a lot to unpack here. No more attacks will be made by Israel pertaining to this extremely valuable energy asset of South Pars Field, unless Iran unwisely decides to attack, in this case, Qatar, right? So it's interesting because he's putting all these things together in a sense that I need to go back to the start of this message, in fact, here. So let me just read it out. So Israel, out of anger for what has taken place, has violently lashed out at a major facility, South Pars, in Iran. A small section of the whole has been hit. The U.S. knew nothing about that attack, and that Qatar was in no way involved in it and did not have any idea it was actually going to happen. Unfortunately, the president says, Iran also did not know this and unjustifiably then attacked a portion of this gas facility, this major LNG facility, which we now understand 2 of the 3 fires have now been contained. So it seems that the last 12 hours, if I could count it by 12 hours, has entered a cycle of who did what, escalation, and where did this start? But clearly I need to
I think it's very interesting as well. I mean, to me, it seems like a clear attempt at de-escalation, and it maybe points to also the political pain that Trump is experiencing at home, and what you're seeing as well being reflected not just in the Fed, but also in bond markets as well. But our team is currently hosting a live Q&A on this subject. What essentially the situation in the Strait of Hormuz means, not just for China, rest of Asia, global story as well. But if you are a Bloomberg Digital or Terminal subscriber, you can ask us questions. So do join that if you're interested. It's always available as well for replay later on. But that is happening right now. And this is Bloomberg.
Right, welcome back. Just more on the breaking news in the last few minutes or so, and hence why Brent prices were above 5% at one point, still substantially higher for the day. This seems to be, as Bell correctly pointed out, this seems to be a move from the president to de-escalate what seemed to be an escalation of the last couple of hours or so. Who was behind this, who's in charge, and who started all of this, because I think when you woke up this morning in Asia Pacific, energy markets were two things. One was you had this massive gas facility in Qatar, and we are trying to ascertain, based on the commentary coming from the Qataris, that they've now said we're looking at quite severe damage here, and to what extent that can be brought back online. Separately, of course, in Iran, South Pars, and who attacked, and the U.S. said they had no idea.
Which I find very interesting, because it's sort of an attribution of blame, I guess, and a distancing that we're seeing. And as we'll be discussing, it's also that question of why is Trump feeling the need to make that right now, that statement, and maybe does point to the huge amount of political pressure he's facing at home. There's the majority of Americans do not support this sort of intervention. You're seeing, of course, gasoline prices that are continuing to rise. There's lots of pressure. There's lots of questions around inflation or resurgence of inflation, stagflation. What does it mean for the Fed? It's a very precarious situation he finds himself in, especially when, going into this, he was thinking it would be a short-term conflict. It's certainly not shaping up that way.
Yeah. Our Laura Davison a few days back put it very clearly, in fact. So we have to distinguish between U.S. efforts to de-escalate the war, if we're seeing that at all, versus U.S. efforts to address the symptoms of what's going on because of the war that's taking place, and, of course, the damage we're seeing across energy markets. Speaking of damage, one glance at equity markets will tell you everything you need to know about the damage in markets today. Nikkei, Kospi, Taiwan, and Hong Kong coming up on your screens very shortly, and we are seeing quite a sell-off right now. Volumes, though, are on the lighter side of things. Yeah, but just to say, I mean, every sector's in the red today except for energy, of course, standing out. But if you do want more information, just a reminder, our team is currently hosting a live Q&A again on this situation in the Strait of Hormuz, particularly focusing on what it means for China, the rest of Asia, global story, of course, the implications. But if you are a Bloomberg Digital or Terminal subscriber, you can ask us questions, so do join that. It's also available for playback later on. So this is happening right now, and you're watching Bloomberg. All right, welcome back. You're watching the China Show. Just to recap the breaking news in case you missed that. Truth Social post out of the U.S. president talking about a few things, but effectively saying that the U.S. knew nothing about the attack on, I think it's South Pars he's talking about here.
Yeah.
And then it then led to this escalation between Iran, Israel, and Qatar, and we're now looking at oil assets. Now, the interpretation markets are taking from this is a good thing. When you look at how the direction of assets right now, with oil was above 5%, we're now at 3.8%, and U.S. futures are now also, in fact, at session highs. We're now up 11 points on E-mini futures there.
Yeah, you're certainly seeing a sort of, I guess you could say, a touch of relief that's coming across markets, but a very low baseline as well, because, of course, coming into the session today, it was we'd seen equity futures or equities in the U.S. that were moving low. We'd seen yields that were moving high, particularly at the front end. And we had the Fed decision, of course, and Jay Powell just saying it's really too early to tell. It's such a busy week for central bank decisions, and that is really sort of the key question that comes out of every meeting for policymakers. How are they thinking about this situation and how long it persists as well? What are the energy implications? And this is a region, of course, Asia, that is particularly exposed to what's going on in the Middle East.
Yeah, and you know what? The short answer is, I think, there is that they're saying they don't know, because a lot will depend on how long we be in the situation. Really, more related news here. So, Etai News, a headline crossing the Bloomberg terminal. Speaking of surcharges and fuel surcharges and airlines, several Chinese airlines will be raising, as expected, that tariff on fuel. That one just coming through as well. It's also worth pointing out we're now also hearing from the Japanese. As we look at dollar yen at 160, that they can't manage economic policy for the purpose simply of influencing FX. That's just to say 160 is a level we're tracking on dollar yen, and whether or not that will be intervention levels. And of course, we're moving into the BOJ at some point, should be breaking any moment now. So all the confluence of factors coming together here, Bill.
Yeah, and it's certainly been a day as well that we've really watched what's happening in the EMFX space, because you had the Philippine peso, for instance, moving past that key 60 level, and the Korean won as well, moving around 1,500.
Right?
Yeah, so another key one to watch. But again, just coming back to those inflationary pressures and what is the impact for these major energy importers in this region?
Yeah, the guest who joined us about 20 minutes back said, when you look at the damage, you look at South Asia, a lot of very dependent and exposed to energy gas supply coming out of the Middle East, Southeast Asia, of course, and you see that in the currency
India,
markets.
Bangladesh, Pakistan, it's a lot of different countries.
Yes. Okay. So lots to unpack. In fact, coming up in the next segment here, ING we actually asked ING to join us to talk about the Bank of Japan meeting. That conversation has now shifted. We'll be talking about Korea and this poleaxing we're getting there, and as far as the currency is concerned, what the impact really will be. Anyway, stay tuned for that interview coming through as well. There's also an earnings undertone across these markets to tell you about. So Tencent is one earnings reaction there. Alibaba's coming out with earnings later today. Apart from that, travel, of course, we'll be getting into that, of course, coming through as well in a conversation in about a couple of minutes or so, and really what we're seeing as far as that is concerned. Oil prices, energy counters on your screens, an update of markets, and all those things we just flagged in a couple of minutes. We'll be back shortly. We'll take a short break. This is The China Show.
It's 11:29 a.m. in Tokyo. Japanese markets are just about to go into their lunch break. We bring you a live shot here this morning of the outside of the BOJ. Of course, we're on watch for that decision. It'll be an interesting one because usually the more consensus there is, the earlier you get it in the mornings. But at the same time today, of course, the complicating factor is what's going on in the Middle East and how policymakers are thinking about that as well. So leave you there with a check on markets. But it's really just, again, trying to understand that risk from what's happening in the Middle East.
Yeah, and the BOJ arguably was already behind the curve there, and whether this actually forces their hand to at least sound more hawkish this time, given that inflation is quite there. And yeah, I mean, this live shot is not something, of course, we normally do. We're, of course, on the ground there at the BOJ. The normal shot that you actually get is out the office into the Imperial Palace, Marunouchi, where I think you have a little bit of the Palace Hotel. Slightly to the left, it's I think it's the Imperial Hotel. Slightly beside that, I think, is the Peninsula, actually. Speaking of, I was going there. I was going somewhere with that. The operator of the Peninsula Hotels brand has returned to an annual profit, posting full-year net income, $41 million, that's US dollar. Joining us exclusively here on set, Benjamin Vuchot, CEO at the Hong Kong and Shanghai hotels. Very nice to see you. Sorry to keep you waiting. We've had some breaking news, so thank you for being patient.
Good morning.
I know you have a property in the Middle East, in Turkey. Just to ask, how's the staff doing? Is everything okay?
Everything's okay. I mean, the hospitality world is a very emotional business. Geopolitical events happen, sadly, all the time. And I think our teams are always prepared to stick together and also ensure that the guest experience is also there to help sometimes, inbound visitors who may not have a choice but to stay in our hotel a bit longer than they had initially expected. So everything well. Thank you very much for asking.
You don't have, I mean, that's the closest, I guess, that you get to the Middle East in terms of your properties. But how are you thinking about the impact of what's going on there? Because we're seeing, for instance, a lot of flight cancellation, there's cost of living pressures. Do you see it showing up at all?
There's no doubt that for a company like us, the Hong Kong and Shanghai hotels, who's the owner and operator of the Peninsula Hotel brand, disruptions in the Middle East have a global impact. And it's the same impact that other hotel operators are suffering. The main causes, really, for us is airlift and routing. So all prices will impact airfare prices. And we're also seeing some cancellations. People are not able to go where they wanted to go. But I don't think we are being worse off than any other operator at the moment. In fact, we do not have a presence in the Middle East, particularly in the area where conflicts are. And while we benefit from a very, very strong patronage of guests coming from the region, we are suffering some cancellations, but I think it's too early to say if this will have a major impact to our overall business. We're waiting to understand how this situation will unfold.
We know that, well, at least I understand that in previous months, you have been visiting the Middle East, of course. I wonder did you have any concrete, how far along were any potential plans for that, and whether or not what's happening there is kind of making you rethink some longer-term initiatives there?
Well, Hong Kong and Shanghai hotels celebrated 160 years this month. So it's a very long-term view company. In fact, we have a quite balanced business today. 25% of our properties are in the United States, another 25% in Europe, and the rest is in Asia, balanced between North Asia and Southeast Asia. So I would say that we are able to mitigate global events in general. And this is really what I think is a strength. The other thing that most of people may not know is that on top of hotels that we have around the world, we also have a very strong business out of Hong Kong with commercial properties. We operate this very, very famous Peak Tram that takes, the most visited attraction after Hong Kong Disneyland, to take all visitors, local and tourists, up on the Peak. And that exposure to Hong Kong at the moment, I think, is a sign of balance and is a sign of mitigating potential travel industry related disruptions that we may suffer.
Yeah, let's get more into the numbers because we've been showing here probably one of the highlights, swinging back into the black for the full year. But what stood out to you in the metrics?
Well, it was really a strong year, 2025. I joined the company about a year ago, and really the team was really focusing on a couple of things. This return to profitability was a big goal for all of us. The good news, it's really been driven by hotel operations. While our revenues grow in total by 11%, our operating profits grew by 43%. So really a good demonstration of the underlying business fundamentals, which are very strong. The rest of the business also performed quite well. So I would say luxury is more resilient in hospitality at the moment. Our guests enjoy how much care we take after the brand and how service levels are protected. But at the same time, my goal was also to bring back some performance to the company and making sure that while we protect the brand, we also make use of the assets. And I think the results are proving that this was the right thing to do over the last 12 months.
So a year into the job, you mentioned you wanted to bring performance back. Perform is just one part. The other thing I think is transform, if I'm not mistaken. Right. Perform and transform. What does that mean that's simple English. What does that actually mean?
Well, what it means is that, with a company that's so stable and that has a very, very good balanced business between hospitality and commercial property assets, there really is an opportunity to capitalize on what we have and bring more value now grow what we have now, which is the perform part, in order to transform, which is to go back into a growth mindset. For the last couple of years, we had a very capital intensive campaign. We opened more hotels in Europe. We are now into stabilizing, benefiting from those recent openings, but preparing also for the future. And the transformation is really about our business model, particularly on the hotel side. We are one of the few hotel companies that still own all of their hotels. In fact, 25% of our hotels we have a minority shareholder, but we act as a minority shareholder. Our way forward is really to bring more of an asset-light strategy, which is more partnerships, less ownership. So it's not something totally new for the Hong Kong and Shanghai hotels. As I said, 25% of our properties are already in a shared ownership perspective. But this is really about making sure that we can engage into a growth strategy, but also have more partnerships and capitalize on those partnerships to grow faster than maybe what we could have done alone. So we're very confident that this is the right thing to do. This is something that many hotel luxury operators have been doing for many years, and it's for us about to do it at the right pace. Volume is not what we're chasing. We're chasing where our guests want us to go next. And this is really about being growth oriented, but with an intention. So it's intentional growth. And to grow, you need to make sure that you're strong and that you perform. So perform and transform is really the two pillars for our strategy. We coined it Vision 2035. We We was just finished after 1 year of strategic review, which was completed in December last year and endorsed by the board.
You mentioned it's nothing new, the 25%, which is a part of the business you don't fully run, of course. Is it accurate to say you want to see that piece of the pie take up a larger portion of the business?
I think, in fact, what we want to make sure is that we have choices in how we run the business. There's lots of benefits of owning and operating hotel operations. And there's also, to grow faster, you can go into a very asset-light model. Right. In fact, having skin in the game is what has differentiated the Hong Kong and Shanghai hotels. We have 20% of a hotel in Paris, 20% of a hotel in Beverly Hills, and many other joint ventures that we have around the world. So is it asset-heavy, is it asset-light, or is it more asset-right? And I think this is what really is driving us now in making choices for the future and making sure that we go where our guests want us to go. We capitalize on this change of travel patterns, which is more about luxury experiences, not just about a fancy, beautiful hotel room, but also what dining experiences, what wellness experiences are we going to provide, and what are the experiences we can bring outside of the four walls of a luxury hotel. We're very, very famous for our car rallies that we arranged either in California or recently in Tokyo, and we're about to launch one in Scotland this year. This has nothing to do with a physical hotel, but this is how do we stay connected and build loyalty with our guests and create luxury experiences and celebrate moments together.
Yeah, and as you said, luxury a little bit more resilient in times like these. Well, Benjamin, thanks so much for joining us this morning. That was Benjamin Vuchot, the CEO at the Hong Kong and Shanghai hotels. And just a quick check on markets as we go into break. We are seeing, again, lots of pain across the screen this morning, but
we're coming
equities,
off, actually.
Well, yeah, coming off a little bit of relief, perhaps after President Trump's comments, but still we are in the red across every single sector, barring energy. More ahead. This is Bloomberg.
Okay, welcome back. BOJ decision is imminent. That's not really the story when you look at what's happening in oil and gas markets, although we'll see what the BOJ says, depends on what they do. Our attention now has been forced into EM economies that are net energy importers. Japan, of course, is one of them. They're not an EM. Korea is a big one. In fact, let's have a look at these two. Let's start with Korea. Joining us now is Minju Kang, senior South Korean Japan economist at ING. Minju, thank you for joining us. Good morning. I know we are the initial agenda for this morning's date was Japan, but I need to start with Korea if that's okay. How are you? What is your assessment of the country's exposure to the conflict in terms of energy security?
Okay, so actually the recent reports on of the attacks on the energy facility in the Middle East is clearly dampening the market sentiment, also fueling the concerns that the energy price will stay higher for longer, even if this tension ease. And the Korea case is probably most vulnerable to this energy shock, because of the very high the dependency on the Middle East oil and gas. And but the thing is that for Korea case, they have quite large reserves to cover up to probably 6 months of oil, and also the government's very proactively intervening the market to stabilize the prices. So, for example, they set up they already implemented this price cap measure. So they want to reduce the burden for the consumers. I think that it will help to alleviate the oil price surges for temporarily at least. However, if this tensions get longer, then probably they will have to find more other solutions. Now, what we are seeing is that the government is trying to find alternative energy sources. Not only from the U.S., but also they're tapping the import of the oil and gas from Russia again.
Yeah, and on that, I mean, we saw, for instance, the government imposing a price cap on gasoline, diesel, kerosene last week for the first time in about 3 decades. But does that sort of change the longer-term trajectory around inflation, do you think?
Actually, if, because ING has our base case scenario for this war scenario, and if this interruption of supply stays no longer than a month of time, then probably the impact on the economy should be very limited. And we believe that, the negative impact will be very concentrated in the second quarter of this year. However, we're going to see more gradual recovery from this shock. And also, the government is planning to draft a supplementary budget. The size is estimated to be near 20 trillion won. So with that supplementary budget, I'm sure that it is going to kind of mitigate the short-term shock for the economy.
And how should we expect the currency specifically to move short term? Should we expect a further adjustment in the currency weaker, or will the government in some ways try and, I'll borrow your phrase, mitigate some of the currency movements?
For the currency movement, in Korea, we kind of tend to think that 1500 level is very critical, and also we expect that some interventions will come into play. However, this time, actually the weak Korean won is mostly driven by the strong dollar, US dollar. So we believe that this intervention is not going to be very significant to impact or change the direction of this Korean won weakness. So for now, we believe that we have to see more upside for the Korean won level. So for now, we believe that the short-term range, we believe that it's going to be more 1450 to 1550 level, the range. So, and given that a very high, high beta currency as, the Korean won has the nature. So that's why we believe that, the range should be very wide, and also, expect quite a large volatility in near term, depending on the situation in the Middle East.
Let's also keep on that currency story, but take a look what's happening in Japan, because, of course, we're tracking the Japanese yen, trading back down to around 160 right now. It seems like, of course, intervention is the word of the day for both Japan and Korea. And actually, just on that, we've just had the BOJ keeping its rate unchanged at 0.75% and actually adding as well the Middle East to the list of economic risks. This was a vote very much the consensus, 8-1 to keep rates unchanged. So just one dissenter, and very much according to our economists' forecasts as well. So the BOJ decision just out, as we said, that overnight call rate at 0.75%. Just give us your initial reaction to that. Of course, it was very much expected by economists.
Yeah, actually, today's on hold decision was widely expected. We probably think that the BOJ would like to have more time to evaluate how the situation in the Middle East is going to might impact on the economy. Also, they'd like to wait the outcomes of spring wage negotiation result, which will come in April, and also they'd like to kind of assess more about their earlier rate hikes on the economy. So these factors should be the reason for the on hold decision. Going forward, it's going to be how Governor Ueda is going to communicate at the press conference. Markets will, very closely, watch that, his remarks. However, we believe that, Governor Ueda would not drop any hint at the timing of the next rate hike, because the BOJ would like to keep maximum, flexibility for their policy decision. We believe that they're going to repeat their more directional trend that, we have heard several times already. Like, if the economy continues to recover and inflation approaches to 2%, in line with the BOJ's outlook, then, the BOJ will, continue to adjust their policy conditions. So we believe that, and also the way how he addressed the upside risk of the inflation versus downside risk for the growth, that probably give kind of hint for the timing of the BOJ's rate action in coming months.
Minju, I'm just going to read through some of the parts of the statement out for your benefit, hopefully clear. It's actually rare that we get a specific reference in the statement to an external event so frequently. The Middle East has come up at least 3 or 4 times in the statement, that it is one of the risks that they're tracking very closely, that the recent oil price rise will be helping them boost inflation. It's obviously something that they're noting in as far as how quickly oil prices have risen. While we don't know when they will move next, and to your point, they might just keep the door very open and vague on that. Near term, though, what impact do you see to the consumer because of this? All the oil price references that the Bank of Japan is just laying out for us now.
Actually, we believe that because the government set up this price cap measure effective today, so we're going to see this impact will coming through for next couple of weeks, and then we are going to see some stabilization of gas prices at the station. However, yes, but the thing is the rising oil prices can in a way dampen the consumers' purchasing power on more discretionary consumption goods and services. So in that sense that it could in a way that what the BOJ is looking for is the more sustainable inflation, underlying inflation growth. But however, this higher oil prices may dampen the consumer consumption recovery. So that's why we believe that the BOJ may want to see really this this trend is transitory, or is going to have a more prolonged impact on the inflation expectations. However, like you mentioned that it's very rare that to see this comments on the statement. So which means that they really kind of see the more significant impact of this situation on the inflation. So I can tell that they are more concerned about this near-term inflation hike. Inflation hike is going to have boost more inflation expectation rather than they kind of worries about the this impact on the consumption, negative impact on the consumption side.
Minju, thanks very much for joining us. As we said, the BOJ keeping its rates unchanged at 0.75%, but very much flagging the risks around the impact of what's going on in the Middle East in particular. That was Minju Kang there joining us from ING Bank, the senior South Korea and Japan economist. And terminal subscribers can, of course, turn to the terminal for more on this. T-Live Go, that's your function. We've got a Bank of Japan monetary policy decision blog underway right now. So do check that out. More ahead. This is Bloomberg. You're watching the China Show, just recapping what has been out in the last couple of minutes here. That's the BOJ keeping its overnight call rate at 0.75%. Very much expected. I think if there's anything that's come out, and the nuance of this so far is just how much what's happening in Iran is factoring into at least their outlook and their ruminations, essentially.
Which is rare, right? That they reference something external so many times, which market reaction, not a lot. Cash markets are shut. You look at futures, also not a lot there. I think it's worth pointing out this hour the big news with reference to Iran was the post from the U.S. president, which seems to, there we go, helping de-escalate the situation. Markets are responding. U.S. futures session highs were off lows here in the Asia Pacific.
Yeah, but I would also caveat that, I guess, just with saying that we have seen volumes that are looking pretty thin across the board. And when you actually drill down into the sectors, I mean, it's been pretty much every single one in the red, bar energy, of course, that's continuing to move to the upside. Though, as you said, we have seen, I guess, a little bit of relief perhaps seeping into sentiment as well. But that's it for the China Show. Insight with Haslinda Aminis next. Do stay with us.